Hey, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. It is Tuesday, May 28th, and you're tuned in to On Trend, the show designed to keep you on the right side of the trend. So we're going to start with the major index ETFs and show that they may be walking down the lower Bollinger Band. We'll overview the sectors with a focus on healthcare. We'll look at breakdowns in some key industrial and discretionary stocks, and we'll finish with FAAAM. So I'm going to start with a 6-month candlestick chart for SPY. And even though it's just 6 months, we can get some long-term information out of this chart. First of all, you can see the 50-day is above the 200-day there, and it crossed above in early April. The middle line of the Bollinger Band is the 20-day moving average, and it started to move down, but it's above the 200-day. You can also see prices are just above the 200-day, which is flattening out here. So long term, we would still have a bullish bias because, we had a 52-week high there in early May, the 50 days above the 200-day, 20 days above the 200-day, and prices above the 200-day. Now, I think the important trend to watch here is really this big upswing we've had, this upswing that started with that December low and that big surge, and then we had a 52-week high there in early May. Now, we've pulled back, but so far it's not a trend reversing decline. As I said, we're above the 200-day, but we've got some short-term bearish signals that suggest further weakness maybe to this 270 area. And how did I get that? Well, if you see, you have this decline here, and this decline is roughly 295 to, we'll call it 280, so 15 points. And you had a little pennant after this decline, and then you have that gap down on Thursday, and that gap is holding, and it broke the pennant line. So if you measure around a 15-point decline from, say, 285, that's a very rough measurement, but targets are always very rough targets. It takes us to around 270, and that would be a break of the 200-day moving average. So the short-term situation looks bearish as far as I'm concerned after that pennant break. But the long-term, we haven't had a breakdown in the S&P 500 yet to suggest we're in a longer-term bear market. Now, on the indicator, I've got the Bollinger Bands there in pink, and then I've got %B in the indicator window. And I showed this last week, and this time I've got the horizontal lines at 1 and 0. And so when you move to 1 and when you move above 1, you're getting to the upper band. And when you move above 1, you're getting above the upper band. So you can see here we got to the upper band in early February. We got above it in March. And we got above it in April. So we're kind of hugging this upper band in a strong uptrend. But now the opposite may be occurring. You can see we move below the lower band there. And we're kind of hugging this lower band. We got a bounce, but we didn't get back above the 20-day. And now we're continuing lower, so we could hug the lower band. And these bands will expand if volatility expands because the Bollinger Bands are based on the 20-day moving average. And then the upper band is 2 standard deviations above. And then the lower band is 2 standard deviations below. So as volatility increases, the standard deviation increases, and that makes the bands widen. But at this point, I'm short-term bearish, but I have yet to see this big bear market signal for the S&P 500. So here's QQQ, and we've got a similar pattern at work here in that you can see we were hugging the upper Bollinger Band here for quite some time during that strong uptrend, and now we've broken below the lower band. It wasn't as good of a pennant because this bounce was weaker, but it's still some sort of consolidation, and you got the gap, and you got another gap, and you've broken down again. So it looks like we're hugging the lower band, and we could continue lower for QQQ. And then if we look at IWM, it is the weakest of the three because small caps continue to lag. There you can see, you got the break below the lower band, but then you move right back up above the upper band. And that was overbought, obviously. It wasn't a breakout signal. And now you move below the lower band. Sometimes you don't always hug the upper band and continue higher. Small caps, interesting thing is they are much more diverse than, say, the NASDAQ 100, which is a bunch of tech stocks, where small caps, you got financials weighing big in the small cap ETF. You also got industrials and healthcare. And financials and industrials don't play a big role in QQQ. But if you look here, we've got a break. We're underperforming because the NASDAQ or IWM here moved below that March low. So it's got a lower low already and a pennant break. So it looks like it is headed lower too. And I'll just show a weekly chart of the S&P 500 to show you it's a tortured market. It's a tortured, volatile market right now. Gone are the glory days of 2016, 17, and into early 2018, we had this monster advance. No, we've had a seriously sharp decline, a big advance, a sharper decline, and an even sharper advance. And in the meantime, we're kind of back near these January 2018 peaks. We're below the autumn peak in 2018. Yeah, we're above the 200-day, but this is a volatile market that is not sure what it wants to do. And you can see there's pretty much an inflection point here because you're above this 40-week moving average. You're above this resistance breakout. You firmed last 2 weeks, or actually 3 weeks. If you look at those candlesticks over the last 3 weeks, you can see they're indecisive. They're spinning tops. Because what you have is you have a high-low range, and then you have a middle there featuring the weekly open and the weekly close. And so you went up and down, but you ended up in the middle kind of, and that shows indecision. So this is an indecisive point where the market's trying to make up its mind if it wants to complete the bearish breakdown or bounce and save the bull market. So I want to show some candle glance charts for the 11 sector SPDRs to give you a kind of state of the market overview. But before I do that, I want to show you how to create a custom candle glance style that you can apply to all your candle glance charts. So what I've got here is a basic sharp chart, which is where you start. And you need to set that chart to the indicators or settings that you would like. And I just want a simple moving average. And for candle glance, I just like a solid line because I want to filter out some of the noise and see a bit of a bigger picture from my candle glance chart. So I've got 1 year, 1 month, and I've got RSI as my kind of standard indicator. And once I've got that chart looking how I like it, I'm going to replace, and if you see on the chart styles, I've already got one called Candle Glance, and you'll have one too, any member will. And I'm going to replace that Candle Glance, and that will be my new Candle Glance chart style. So I'm going to go over now to my sector SPDR chart list, and I keep chart lists with different groups that I like to look at when I look at a whole group, and I'll show you that with healthcare in a minute as well. Then we click View All, and from 10 per page, I go to Candle Glance. And you can see now we have the style that I just created for my custom candle glance style. There you see custom style up there on the left. And so now I can look at the 11 sectors on one page, and I get 3 across. Depending on the width of your browser, you may get 4 across. And we can do some just basic analysis to see what's going on here. So we've got technology, and it's above the rising 200-day moving average, and it did hit a 52-week high, but it has come down very hard here in May. We got finance, did not hit a 52-week high, and is right near its falling 200-day moving average. So it's kind of one of these ones that's kind of in limbo, right? It's above the 200-day, but the 200-day is falling, and it didn't hit a new high in late April, early May. Same with industrials. You got a lower high here in 2019 based on the 2018 high. And you're right at, it's kind of a real inflection point there. You have broken resistance, turning support kind of, and you got the 200-day right there as well, the red line. So this is a support level to watch for industrials, and if we break down there, that's going to be another negative for the market. We look at consumer discretionary. We got a 52-week high. We're above the 200-day, but we came down very hard in May. So this one could have further to correct, maybe back to this 200-day around 110. You can kind of see some broken resistance and that consolidation from February coming into play as well. Communication services did not hit a new high. So anything that didn't hit a new high is not a true leader. All right. So XLK and XLY hit new 52-week highs this year. They exceeded their 2018 highs. They're leaders. And you can see XLC did not, but it is above the 200-day. And you can kind of see a resistance level turning into support and the 200-day there. So a test coming up here. Healthcare is kind of the weird one because, the 200-day is kind of slightly rising here. And you got this kind of consolidation, this triangle formation. And I featured healthcare on Friday. And so it's like a big symmetrical triangle taking shape. And if we get a breakout there, that's going to be bullish for healthcare. And money may find its way into healthcare if it continues moving out of technology and if industrials break down, because it is a defensive sector. And then if we scroll down, we can see two of the real laggards and two of the real leaders. The laggards, energy, did not clear its 200-day. Its 200-day is falling, and it broke down. So it looks like it's headed for a test of that December low. Materials, a lower high here, well below the 2018 high, below the falling 200-day moving average. So this looks like a continuation down as well. Those are the two weakest sectors. And then you get to the real strength. All right, we have REITs, utilities, and staples hitting new 52-week highs there in May. So they are the real leaders here when you're hitting a 52-week high. They're above the rising 200-day moving averages, and these are the defensive sectors that are attracting the money right now. And there we can see SPY kind of caught in the middle. But the bottom line is, it's a defensive-oriented market with the leaders being staples, utilities, and REITs, and I'm seeing some promise maybe in healthcare. And John Murphy also featured healthcare in his commentary on Friday. So I want to dive into the healthcare sector. Before I do that, let's just look at a weekly chart of XLV. And we can see here that there's an overall uptrend, I think, at work when you look at it at work over the last, say, 3 years. Overall prices are moving from the lower left to the upper right. Now, you can see prices have pretty much been flat over the past 9 months or so since October as we've moved sideways with this big symmetrical triangle. And if we get a breakout there, you can see a clear resistance zone there. So if we get a breakout above those highs here, then that is going to be a bullish development for healthcare. Now, the 40-week moving average is shown in red. And then below, I've got a 426.0 PPO. And that's the difference between the 4-week moving average and the 26-week moving average. And there's nothing magical about this pair. It's basically a 1-month moving average divided by minus a 6-month moving average. And you can see when it turns positive and you're above the 40-week, that's a bullish signal. And there we can see another good signal in May 2018. And we got a whipsaw here in January 2019 because it didn't last long. We broke down. And so I'm watching for this to potentially happen again, where the 426.0 PPO turns positive and we break above the 40-week. So that's something to keep an eye on. Now, I want to take a deeper dive into the healthcare sector and look at the individual stocks. And how would I do that? Well, what I'm going to do is create a chart list. So here I am on that healthcare chart, XLV, and up at the top I've got an edit list button. And what I want to do is create a new chart list. So over on the right, I'm going to click that button, new chart list. And I'm going to create a chart list called Stocks XLV. So once that list is created, I can populate it with stocks from the healthcare sector with just a couple of clicks. So if you see Add Charts to Chart List down below, I'm going to click From Group, and then from the predefined groups, I'm going to go down and I'm going to select Healthcare, S&P Healthcare. So all the stocks in the S&P 500 that fit in the healthcare sector. And I click the Add Charts button, and the algorithm will run, and there I get 62 healthcare charts in one chart list. And so now I can use that in a scan. My favorite is Candle Glance. So I'll go to Candle Glance here. And what you can also do is you can do a sort. So I'm going to go 6 month. And once I've got 6 month Candle Glance charts, I'm going to add an indicator. And I'm going to add the PPO. And I'm going to add a 1-200 1 PPO, and that's going to show me the difference between the price, which is the 1 here, and the 200-day EMA. So the PPO is going to be positive when the price is above the 200-day, and the PPO is going to be negative when the price is below the 200-day. And let me just slide that over for you, put it in the middle, and then I can sort. So I'm going to click for a descending sort, and that will refresh. And now all the ones that are the furthest above their 200-day EMA will be at the top. And there you can see I've got the PPO in the window there. There's the value. So this one, IDEX, is 17.9% above its 200-day EMA. There you can see the PPO has been positive since March there. And you can see the chart. So all the strongest ones are going to be shown here at the top, and I can go through them and look for some patterns that I might find interesting. And just looking through this, you can see we've got ResMed, I believe is how you would pronounce it, but it's got like what looks like some sort of a high and tight flag working here. It had that big advance, and then it consolidated. So it looks like it could be poised for a little breakout here. You look at Thermo Fisher. It hit a new high and then kind of consolidated with a triangle pattern, which could be just a rest within the uptrend and could get a breakout and a bullish continuation there. Scrolling down, Abbott Labs, I'm going to have a little bit later. And I just want to get down to the part where we start getting negative in the PPO. So you can see all these PPO readings are positive. And we get 30 charts on one page. So 30 out of 62 have a positive PPO. That means they're above their 200-day EMA. There's the value, 2.735, and there's the actual PPO line just above 0. So I'm going to go to the next page, and then we're going to get into some negative numbers. Here we got AmerisourceBergen, and that it's 0.003. So the PPO is barely positive, but you can see it's got a little bit of a breakout this week. And then when we get to Gilead Sciences, it's the first one that is negative. Maybe it's building some kind of a base, but it needs to get a breakout at 68. So the ones that are from below Gilead Sciences and Becton Dickinson here and HCA Healthcare, you can see their PPOs are negative, so they're below their 200-day EMAs. So I'll look at some individual healthcare charts, but first I'm going to put Walmart in there because I would think Walmart is more consumer staple than consumer discretionary. I think people go to Walmart for their staples. I could be wrong, but if you look at this chart here, you can see a big consolidation. You can draw your lines differently if you want, but all these lines are relatively subjective. But basically, you've got a big consolidation here that's winding up and getting tighter and tighter. And then within that consolidation, you had a little breakout here. So Walmart is showing some strength and looks like it may be poised to break out and try to get a new high. Now moving to the healthcare group, Abbott Labs did catch my eye because it is consolidating near its highs here. There you can see we got kind of a triangle possibly forming. Now we haven't bounced off this low to complete the triangle, and obviously we need a breakout there to confirm it. But I'm noticing, look at that move we had on Friday, that first bounce off support there, and we're above the rising 200-day moving average, and that was a 52-week high in March there. Then if we look at Insight Pharmaceuticals or Insight Corp, we can see what looks like, I featured this one last week, there is a big resistance zone and a big breakout, and you can see that zone turns into a support zone, and we're testing it twice, and we got a really strong bounce off support this week. Now this is a relatively volatile stock, so it does carry added risk, I would think. Johnson & Johnson, now this one's a bit weird after this, big gap down, but it has recovered steadily, and it's above the rising 200-day moving average. So I think I would give it the benefit of the doubt as long as it holds that rising 200-day moving average. And here is Merck. And we can see Merck is in an uptrend here. It's above the rising 200-day moving average. You had a little bit of a pullback here, and then we got a breakout from that pullback. So it looks like Merck wants to go higher. And Thermo Fisher, I showed you that one on the candle glance charts with the triangle after the new high. And Boston Scientific, which was featured in Don't Ignore This Chart last week, you're above the rising 200-day moving average again there. And it looks like this was some sort of a correction after a new high. It was deep, but we got a breakout there. Trying to draw that straight there. But it looks like we got a breakout there on Friday, so I would expect Boston Scientific to move to new highs. And that's part of the medical devices group. And then Danaher, which is also part of the medical devices group, but it's really a conglomerate, I think. But it kind of had this flag type pattern here with this little flag wedge pullback and trying to break out, but stalling here. So yeah, it might be vulnerable to a pullback, but it's one of the stronger stocks and in a clear uptrend. Now, one thing that's got to be a big concern for the broader stock market is some of the weakness I'm seeing in some key industrial and consumer discretionary stocks. If you look at Emerson Electric here, EMR, an industrial stock, a lower high here. And, you could draw your rising wedge if you want. And that's a breakdown with a gap below the 200-day moving average. And the 200-day moving average is turning down. And it's just falling apart. And this is just your basic industrial stock breaking down. And then you look at FedEx. It's in the industrials group, but it's an air freight company, so it's very tied to the economy. And you can see that it wasn't even strong here in April because it didn't even get back to its falling 200-day, and it's broken down here. So that is not a good sign for the broader market. UPS looks just as bad. Here's another transport stock, JB Hunt, and it broke down here. Steep triangle, if you will, but it failed at the 200-day, failed below the 200-day here, and then you can see the breakdown and weakness again last week. So JB Hunt is hitting a new low. That is not good. Textron, an industrial stock here, and another bearish pattern. Look at this decline in October, November, December, and we did get a bounce, but you can see that this bounce didn't clear the 200-day. You failed at the 200-day, and you're breaking down again. So there's a lot of weakness out there that is of concern from a broader market perspective. Here is UPS breaking down. It's not my favorite wedge trend line, but look at the gap below the 200-day and the steepness of this decline and a clear break below that support level. And now you got a falling 200-day moving average. Then we look at United Rentals, all right, another stock closely tied to the economy, with that big move down in September, October, November, December, and then it rallied with the rest of the market, but didn't get even close to its 2018 highs, broke below the 200-day, which is falling, and is breaking below that wedge line. Now, do I think these are shorts? No, I'm really not a fan of shorting the stock market, because all it takes is one tweet to give you a big rally. But I think these are patterns that are negative for the overall market and could come to weigh on the S&P 500 if we see more weakness. Here's Alaska Air, of course, an airline stock hitting resistance at the 200-day and looking poised to break down there. Then we have Booking.com, which is, of course, travel industry focused. And we can see that it's below its falling 200-day moving average. And this was kind of a triangle consolidation, and now it is breaking down. So this does not bode well for the travel industry. And American Airlines hit a new low. And then if we look at CBS, all right, this is broadcasting, a breakdown there in February and August, October, November, December. And then this kind of big wedge thing that we're seeing, and we're breaking down. And finally, Expedia, another one tied to the travel industry. It was trying to get, I thought it was getting a breakout there, but this breakout failed miserably. And we're back below the 200-day, which is turning down. So, industrials, consumer discretionary, travel, airline, getting some weakness. You saw what happened to retail last week, so the negatives are stacking up. So we're going to finish with some FAAAM stocks: Facebook, Amazon, Apple, Alphabet, and Microsoft. And we can see here Amazon first. Now it's above these highs here, so this resistance zone turns into support, and it's above the 200-day moving average, but it looks like it's heading for a test of this support zone. The only bullish thesis would be this is a wedge, a bull wedge, and a breakout there would be bullish. We look at Facebook, and we can see short term, it's breaking out of a pennant. So this looks like a short-term bearish development that could bring it back into this consolidation zone marked by the consolidation from February, March, and that 200-day coming in there. We look at Google, and it is just all over the place. It hit a 52-week high and then had this massive gap. And it didn't bounce until the middle part of May, and then had another gap down. So this one is everywhere and nowhere, but I think these gaps and this breakdown dominate, and that would make Google bearish. Microsoft is holding up the best of the group, but it could also be vulnerable to a correction. I mean, keep in mind, it had a 40% advance from late December until late April. So it is entitled to a pullback. So we get this gap here, and we're kind of just consolidating. Now, we could get a breakout and a continuation higher, but if the market softens, Microsoft could soften here and move back towards that breakout zone and say a 50% retracement back to the rising 200-day moving average. And then Netflix, which I think is one of the weakest of the group here, we can see a lower high there. Didn't make it back to its summer highs. It's pretty much stalled out since February. And you got this sharp decline, a kind of a pennant thing. And it looks like if we break this pennant, we could break the 200-day and head lower for Netflix. And that concludes this edition of On Trend. Thanks very much for tuning in. And remember to stay on the right side of the trend. Have a great day.